Howdy everybody, welcome back to Accounting 1101 where we are all about closing time in our video today. Closing time is the magical time in the accounting cycle where we close out the accounting books to get ready for another accounting cycle. And the game is essentially over at that point when we're ready to do closing. If you think about the game being over, we've made the income statement, we've calculated that net income. We've taken that net income and used it to create our statement of owner's equity, which gave us our ending capital amount, which we carried over to the balance sheet. We've made the financial statements and we're ready to share those financial statements with whoever wants to see them. If you're a publicly traded company, that means the investing public. If you're a privately held company, that probably just means the management of the company. But in any event, the game is over. It's no different than a game you might go to as a sports fan. You go see the Reds play, you go see the Bengals in Cincinnati, and at the end of the game, you'll see a score up on the scoreboard that tells you the result of the game. In the case on the left here, one of the rare instances where the Reds got a victory, and the case on the right, the Bengals winning a playoff game. Either way, at the end of the game, the scoreboard has a score on it. Just like your financial statements have a score on them that show you how the business did. And so what happens is we have to reset the scoreboard back to zero. If you imagine in a sporting situation, the Pittsburgh Pirates might be kind of put out if they came back the next day and the score was still 11-3, right? They wouldn't be too happy about that. We got to turn the scoreboard back to zero. But we don't want to reset everything back to zero. And I'll give you an example here. Here's another Reds victory. Reds beating up on the Cubbies here, 10-1. When they come back the next day, it'll say 0-0. But these stats down here are going to stay in the record books, aren't they? You think about Suarez here hitting his 32nd home run. He'd probably be a little bit ticked off if he came back the next day and that home run was thrown out. Same with Aquino here, hit 3 home runs that game, a rookie record. He'd be a little bit miffed if they took all 3 of those home runs and thrown them out. So, we're wanting to reset the part of the scoreboard that's keeping track of that particular game. The other stats are going to get carried forward. All right, resetting that part back to zero, and we're carrying forward all the individual accomplishments here. It's the exact same idea in business. We're going to take that income statement that keeps track of the amount of money the company earned during that period, and we're going to turn it back to zero. We're resetting the scoreboard so we can see how much money we make in the next period. All the stuff on the balance sheet, we're going to carry it forward. We're not going to reset it back to zero. And you can imagine Net Solutions, our business here, would be a little bit mad if we turned the calendar to January and all of a sudden all their cash was gone. And all their supplies were gone, and all their land was gone. They might be okay with the accounts payable and the liabilities being gone, but for the most part, we don't want to reset all those good assets back to zero. And so everything on the balance sheet is just going to roll forward. Everything on the income statement, we're going to turn it back to zero so we can play another game and keep track of how much money we've made. We call the income statement, because of that, we call those accounts temporary accounts. They only live for the accounting period, and then they get set back to zero. Balance sheet accounts, we call them permanent or real accounts because they go on and on and on. We don't reset them back to zero. Okay? So we need to learn that process of closing the income statement accounts back to zero, and just kind of leaving the balance sheet accounts alone. And so if we look at that statement of owner's equity, we have withdrawals. That's also a temporary account. And dividends, when we get into that later on, those are also temporary accounts. They just live for the period, and we close them out at the end. The permanent account here, that Chris Clark Capital, is a balance sheet account. It's permanent. So revenue, expenses are income statement accounts, and withdrawals are going to be temporary. We're going to close those out at the end of the period. So our goal in our video we need to understand what's going to get closed out. We need to know what closing an account means. And then we need to be able to make the entries to make closing happen. And so we look at that adjusted trial balance here and we think about what gets closed out. Again, permanent accounts, our balance sheet accounts, do not get closed. They live on and on and on. Our income statement accounts and that drawing account, we close them. They're temporary. And so we need to close out drawing, our revenue accounts, and all the expense accounts. And so I've said closing a few times. What the heck does closing even mean? Well, we look at all those accounts right there. They all have balances in them. Closing simply means we're going to zero them out. We're going to make the account balances zero. And the way we do that is by making a journal entry that does the opposite of whatever the balance is. And so what I mean by that, take that rent revenue account right there. We'll zero in on that. We have 120 in that rent revenue account. You can see right there, it had a credit balance, right? A credit balance of 120. That is our balance in rent revenue. If I want to close that out, that means I want that ending balance to be zero. Closing, zero, nothing in it. Just like if you went to the bank to close your account and they would give you all the money and then your account would have zero. It's closed. Exact same idea. I have 120, I want to get to zero. What do I have to do? I have to do the opposite. I have to make a debit for that exact amount in order to get the account down to zero. 120 minus 120 gives me zero. So 2 steps in our process right here. For a proprietorship, we're going to close out all the revenue and expense accounts. The offset is going to be to the owner's capital account. When I say offset, we had a $120 debit here to rent revenue. The offset means the opposite side of that entry would be a $120 credit to the owner's capital account. So we're taking all the revenue and expense accounts and we're dumping them into owner's capital. Step number 2 that I'm going to show you is closing the owner's drawing account. It too gets closed into owner's capital. Now, that is for proprietorship. Later on, we'll talk about corporations. Step 1 of that process would be very similar. We're taking all the revenue expense accounts and dumping them into an account called retained earnings. If you've been looking at publicly traded companies' financial statements, you may have noticed retained earnings as a line under the equity part of the balance sheet. Our second step would be to close the dividend account to retained earnings. So the exact same concept, only we're closing them out to a different equity account. In a proprietorship, we're closing them out to the owner's capital account. In a corporation, we're closing them to retained earnings. The process, the exact same. Step 1, closing the revenue account. We can see I've taken from our trial balance, we have fees earned and rent revenue. Both have a normal credit balance. We're going to close them out to the capital account. I'm going to show you how to do that right here. We have to do the opposite. We have credits for our revenue accounts. Then we're going to hit them with a debit. Fees earned debited $16,840. Rent revenue debited $120. We'll add those 2 numbers up to get our credit to Chris Clark Capital. So we're literally taking the revenue accounts and dumping them into capital. Hair trigger on the mouse button there. Revenue accounts going into capital. You can see we're debiting the 2 revenue accounts to knock them to zero, and we're dumping them into capital. And that will close out our revenue accounts. You can see right here, revenues have been closed to capital. That is going to increase our equity. Revenues increase equity, don't they? And you can see right here, they're zeroed out. We just did the opposite to zero out the accounts right there. So, capital is an equity account. It's on the right-hand side of the accounting equation. It's going to go up on the right-hand side and go down on the left-hand side or the debit side. So that's how we close out our revenue account. We simply just take the opposite and then we're going to dump that sum into the capital account. Let's close our expense accounts now. We had 1, 2, 3, 4, 5, 6, 7 of them. And you can see they all have a normal debit balance. All the expenses right there. We need to get rid of them. To get rid of them, we have to hit them with a credit for the exact same amount. So I've got a journal entry form up here if you want to go ahead and give that a try and see if you can make that closing entry. Again, we're going to close out all the expenses to the capital account. And so we can kind of look at the amounts right there. I'll give you a second to see if you can put that entry together, and then we'll come back and check your work against mine. All right, and so we're back. Hopefully you had a chance to try that journal entry. We have a debit to the Chris Clark capital account. Right off the bat, I don't know that exact amount. I have to put in all the expenses I'm closing out and add them together, and then that $9,855 is going to be a plug. I have to add up the credit side before I can figure out the debit side. And that debit side is simply going to be a plug to make the entry balance. Debit equal credit. You see, we have, again, our account breakdown here. We have all those different expense accounts. We're hitting them with a credit to zero them out. And then we're taking that total and plugging it in on the debit side. Again, debit to equity accounts make them go down. All right, so you can see we're taking away from capital right here to reflect all of those expenses. The expenses have been closed out to capital. Expenses decrease equity. And so you think about, if you remember when we were first learning our rules of debit and credit, you may have found it a little bit weird because we know if it's on the right-hand side of the accounting equation, that account goes up on the right-hand side of the credit side. But then I showed you all these accounts underneath the equity part, the expense accounts that were going up on the left-hand side, the debit side. Expenses always go up on the debit side. And so, well, wait a second, that's on the equity side. Why is it going up on the debit side? What happens, and what I'm showing you right here, is those eventually get dumped into capital. And it's going to decrease our equity. And so that's why they can kind of live under that equity part of the accounting equation. It's okay, because eventually they're going to get dumped into capital and decrease capital. And that's what happens with our expenses. So, you'll notice that difference right here. I'm going to pause and think about this for a second. I dumped my revenue, I should say, in on the credit side of capital. And my expenses have gone in on the debit side when I closed it. And the difference was $7,105. I want you to think for a second. What does that difference of $7,105 represent? Pause and see if you can come up with it. And then I'll show you. All right, so hopefully you've had a chance to think about that. If you got an answer, what does that $7,105 amount represent? It represents net income, doesn't it? Revenues have been dumped into capital. Expenses have been dumped in on the other side of capital. On the debit side, the difference between the two, revenue and expenses, is net income. We've dumped our net income into the capital account. And so we've closed out revenue expenses. That's step number one. Step number two, we need to close the drawing account. That drawing account where the owner has withdrawn money for their own purposes. And so we need to get rid of it. It has a debit balance. Go ahead and see if you can close out drawing to capital. All right, I'm going to show you the entry right here. We've closed out drawing with a credit. It had a $4,000 debit balance. We got to do the opposite. We've closed it out with a credit. And we have the debit to capital, which is decreasing our capital account. And you can see that right now. We break down the capital. We put in the revenue when we closed revenue. We've put in the expenses when we closed out our expenses. And now we've closed out the draw with that entry right there. So we end up with an ending balance in capital of $28,105. That number sound familiar? When you look at all the closing entries in one place right here, you can see they kind of combine the revenue and expense closing entries. I did two separate entries to kind of show you the process, but we can see all that right there. We can see our entry to close out drawing, and we can see all the expense accounts being dumped into total expenses, closed out to capital. The difference is $7,105. Now, I asked you if that $28,105 amount sounded familiar. That's our ending balance in our capital account. Look at our statement of owner's equity. $28,105 is our final amount. So, the closing process updates our equity under the capital account, right? We started with $25,000 where we had the owner investment. We dumped in revenue, we dumped in expenses, we dumped in the draw, and we end up with $28,105, which is what we had on our statement of owner's equity. So the closing process updates our accounts to reflect what's on that financial statement. Now, all our expense accounts are back to zero. All our revenue accounts are back to zero. Our drawing accounts back to zero. The balance sheet accounts are updated with the closing. And now we're ready to play another game. We're ready to start a new accounting cycle, a new accounting period, and do it all over again. And hopefully we can make more net income than we made in the month before. We're keeping track. We're playing a game. The game is accounting. And hopefully our business does well. So give it a try. After the accounts have been adjusted at December 31, which is the end of the period, the following balances are taken from the ledger of Wilmington Consulting, which is owned by Raoul Wyatt as a sole proprietorship. Here are the balances. I want you to journalize the closing entries on the provided journal form. So I've given you a couple of forms on the next few slides. You can try to close out the drawing, the revenue, and the expense accounts to capital. Give it a shot. Here's our journal entry form. You can print that off. You can write it out longhand if you want to use that as your guide right there. You can write it out and then see if you can make that closing entry. And we'll come back and show you what you should come up with. All right, one final opportunity to get that in before I show you what our closing entry looks like. Here we go. We are taking off the wages expense, rent expense, supplies expense, miscellaneous, and we are zeroing those out. We are closing out the revenue account, and we'll end up with a $41,000 difference plugged to capital, which represents net income. Again, they've kind of combined the two entries there. You can make them separately if you want to. At the end of the day, you'll have a $41,000 net income that you're running to the capital account. We closed out the drawing as well, and then we end up with what we call a post-closing trial balance. Revenue expense, revenue accounts, expense accounts are all gone. We've closed them. They're zero. And so we don't see those on here. We don't see the drawing account on the post-closing trial balance because we've zeroed them all out. So no revenue and expense accounts, no drawing or dividend accounts. The capital balance now reflects the new capital balance that has been updated after the closing. That's it, y'all. You have completed an entire accounting cycle. Now, that is the foundation of accounting. It took us about 4 weeks to go through from the very beginning when we first started learning about the accounting equation up to now. You have the foundation. We're going to practice it a few times. We're going to take all the steps of the accounting cycle and do them all at the kind of one problem, one assignment, and put it all together and practice and make sure we have that foundation down. Because from here on out, all we're going to do is add to the foundation. All the transactions we learn from here on out, all the concepts we learn from here on out are going to follow the same rules that we just learned during our study of the accounting cycle. So from here we're playing add-on. Very important that you have the accounting cycle steps down and you can perform them. That way when we add stuff onto it, you'll be okay. If you need help as we're working through the problems in the accounting cycle, if you can't get your trial balances to balance, if you don't remember an adjusting entry, maybe how to calculate depreciation or how to calculate the amount you need to plug into to your supplies account to get it to work, whatever the case might be, whatever you're working on as you're trying to do that accounting cycle, if you need help, let's chat. As I said, the foundation is very important. We need to have that down before we move forward. So let's take the time, invest the time into your learning to make sure that you have it down before we move too far down the road. Feel free to reach out if you need any help on anything that we've covered. We will wrap up our first unit with an exam. And so that's on tap. We'll have a review session, hopefully get everybody prepared to do a great job on that exam. It'll have a multiple choice part, you'll have a problem part. Hopefully knock both of those right out of the park. So that concludes our lessons on the accounting cycle. We'll come back later on with a few more videos. Until then, take care, everybody.